With the markets closed today, I want to talk about one of the largest loan platform deals that SoFi has ever landed. The news just came out yesterday, and the stock closed up 3% on Thursday as a result of this news. The stock has been severely dragged down as a result of macro conditions, just like everything else. But this news has got me pretty excited because it validates what I've been saying for a long time around the loan platform business being the most exciting side of SoFi's platform in 2025. It is the core of their growth story for this year, in my opinion. And just to give you an idea, since Q1 of 2024, just 12 to 15 months ago, SoFi has done about $12 billion worth of deals through the loan platform business. And this $3.2 billion deal is one of the biggest, if not the biggest. Let's jump right in. I first want to start off by reading the press release. I did a quick skim of the press release yesterday, but I've just been handling other stuff that I haven't actually sat down to read the full press release. And I want to give my raw reactions when I read it. So I'm doing it live on camera. Okay, so here we are in the press release. SoFi secures $3.2 billion expansion to the loan platform business across agreements with Fortress and Edge Focus. So we know that SoFi already had a deal with Fortress in October of 2024. The extension builds on the original $2 billion loan platform business agreement between SoFi and Fortress. And SoFi also signed a 2-year agreement to originate an additional $1.2 billion worth of loans with Fortress and Edge Focus. So the deal is split into two parts here: the $2 billion extension with Fortress and the additional $1.2 billion in loans between Fortress and Edge Focus. The total commitment provided by Fortress for SoFi's loan platform business has now reached over $5 billion. The quote here from Anthony Noto, the CEO, says, "Our continued collaboration with Fortress is a testament to the success, strength, and scalability of our loan platform business. The additional $3.2 billion commitment helps us better meet borrower demand for our personal loans while moving SoFi towards a less capital intensive and more fee-based sources of revenue. We're building strong momentum for our loan platform business in 2025 and beyond." And the global co-head of assets-based credit at Fortress said, "We're excited to expand this mutually beneficial partnership that helps increase the availability of personal loans for consumers and creates a compelling investment opportunity for Fortress's funds." SoFi's loan platform business refers pre-qualified borrowers to loan origination partners, as well as originates loans on behalf of third parties. Okay, so let me share some of my raw thoughts after reading that press release. First of all, like the press release mentioned, the original Fortress deal was in October. It's only been November, December, January, February, March, April, 6 months. It's only been 6 months, and that was enough time for Fortress to validate the quality. And I mean, like they said, it's a mutually beneficial deal, and they want to invest more funds through SoFi. That 6 months later, they're not increasing it by 200 million or by 500 million. They're literally doubling the amount of originations that they want to do for SoFi. So they were so happy that they decided to go ahead and double their investment, even though it's only been 6 months. Like, that is a crazy statement to validate SoFi's quality of loans, SoFi's quality of their loan platform business product. Because I'm just reading between the lines of, number one, where can this go if Fortress is doubling up in this same quantity? Can other partners that SoFi has signed over the last year double up in similar quantities? And second, if they're doing so in such a short period of time, this means that this product must be wildly successful. And it speaks to all the other demand that's out there in the market for SoFi's originations. So that was the first thing that came into my mind. The second thing, and I'm skimming over the press release on my other screen right now, is trying to find any hints around whether this $2 billion extension would be tacked on top of the original term from a timeline perspective, or whether they would see the original investment to the end and then they would start the $2 billion extension as a commitment after that. Because depending on how they structure this deal, this could be super beneficial for SoFi in terms of the actual revenue that they take home. So I'm wondering whether it's $2 billion for the original deal, and only once that ends does the $2 billion for Fortress begin, or if it's $2 billion running its course, and then you just add another $2 billion on top of that over the same time period. But either way, the commitment is there. The money is there for the taking. It's just a matter of, do they take it all in 2 years or do they take it all in 4 years, right? So that's one thing that I read. I don't think that's explicitly mentioned in the press release. So that was one question that I would have, I guess, from this press release. I also found it interesting that the other $1.2 billion in a 2-year agreement was also a joint venture by Fortress. Fortress really, really loves doing deals with SoFi, apparently. And I just want to take 10 seconds to explain what this is, since many of you might be new to watching the channel and you haven't seen my previous loan platform business videos. Basically, what happens is you have a huge fund and they have money that they want to invest and they want to give out loans to people, personal loans most likely. Then they go to SoFi and SoFi goes and finds them their clients. They find them people who apply to SoFi for a personal loan. The client goes to SoFi and says, "Hey, I want a personal loan because, I want to close out some bad debt." And SoFi says, "Okay, well, you're not really the type of client that we want to loan our own money to, but Fortress wants to invest money and you fall within their parameters, their credit box. And so they still loan you out the money, but they do it with Fortress's money instead of their own money. And so they're originating on behalf of others. And for this service, for SoFi essentially going out and finding these people for these loans, SoFi takes a fee, which is around 4% of this total origination volume. So when you look at this $3.2 billion, you should think like, okay, SoFi's revenue is around 4% of this. But it's also beneficial, right? Because SoFi doesn't take on that risk. They're not lending you their own money. They're originating it on behalf of somebody else. They're only a facilitator in this whole transaction. And so one way to think about the loan platform business is really it's SoFi's middleman service for all of these funds that want to have personal loans on their books. And whether these loans are successful or whether the economy tanks and half of these people default, SoFi doesn't care. They've collected their fee. It's basically a finder's fee to basically match up the end consumer with the money from the fund and their parameters around what consumer they're looking for. And that's it. SoFi takes their fee. They have no risk in the game. And it's a really great way for SoFi to make money, because what happens usually is when SoFi is giving out their own money, they have a super tight grip around who they want to lend money out to. And they reject many people because they want to be super conservative about how they're lending their own money. But when you have more and more third parties that have you originate on their behalf, a company like SoFi can then expand how many people it's underwriting to. It can expand how many people it's originating to, because it can expand its credit box, because it's all determined by the third party, what they want in terms of their ideal consumers. And most of these third parties don't have the strict conservative parameters that SoFi will have. SoFi will say, I want somebody making, let's say, $200,000 a year with an 800 credit score. The pool of those people looking for a personal loan is very, very small. But then Fortress is going to come along and they're saying, I want somebody making $150,000 a year with a 700 credit score, which is still a fantastic borrower. It's just a wider net than what SoFi themselves is giving out their own money to. And so at the end of the day, SoFi is going to be underwriting to more people. They're going to be originating to more people. They're going to be saying yes to more people because the money is going to come from these third parties, of which they're going to be taking a fee through the loan platform business. So it's exciting for multiple reasons. Number one is the risk. Number two is it widens the amount of people that SoFi originates to and it helps their own underwriting models. Number three is also if we look to validate the demand for these loans through third parties, just look at all of the announcements we've seen over the past 12 to 15 months. It paints a very clear picture, not only of SoFi's growth, but also of the massive pool of demand out there who wants to do deals with SoFi and who will be lining up to do deals with SoFi after they see each of these press releases. Over the past 12 to 15 months, since Q1 of 2024, we've had roughly $12 billion worth of deals. We had $350 million with PGIM in Q1 2024. We had the $2 billion Fortress deal in October of 2024. We had another $525 million with PGIM. We've had the Blue Owl deal. We've had this latest $3.2 billion deal. It's absolutely incredible to see that every couple of months you're getting more and more deals of this size, because what it does is it makes other funds line up, because obviously there's a reason that all of these funds are going to SoFi to originate loans. They're finding value from it. Like the head of the asset-based credit at Fortress said, it's a mutually beneficial deal for both parties. And so SoFi will have more and more of their pick of the litter around who they want to work with for these third parties, who they want to originate on behalf of. But also from an analyst perspective, analysts now have to bake into their model this massive growth rate around the loan platform business. And the crazy thing to keep in mind here is that when you look at their personal loan originations that they do themselves and you weigh it against the loan platform business originations in a very short period of time, over a year, with a loan platform business, they're doing like 30 to 40% of total originations. So this is what I've said in the past. As we extrapolate multi-year view, the loan platform business can and probably will be doing the vast majority of originations. Management even hinted at this, saying flat out in their Q4 earnings call that they want to move everything onto the loan platform business because number one, it mitigates all of their risks. So all of these arguments around, oh my gosh, SoFi is originating loans, they're going to have defaults on their hands, they're going to collapse like the banks in '08 or whatever. All of this goes out the window because SoFi is just getting a finder's fee essentially. And number two, because the demand is prevalent, it's persistent, and it's going to be growing, and it's a very much a reality, even in the tough macroeconomic conditions we find ourselves in. And all of these PRs are a testament to that demand and attract more attention through these funds that are basically saying, okay, like what's going on over there? Like, why are they re-upping? Why is Fortress doing $5 billion with SoFi's loan platform business in just a year? Hold on, there must be something here. There must be an opportunity for me to also make money there. Let me look into this. Let me research it. Now, I mean, we've done some quick math in the past around their take rates, around how much money SoFi actually keeps around this, and how much money can we expect to fall to the bottom line. In the past, this take rate has been about 4.25%. I expect that take rate might slightly fall as they do more volume of deals, but we're still going to receive more details around that because earnings is coming up in just a couple of weeks on, I think it's the 28th that earnings is coming up. But it's the Tuesday of the last week of April when earnings is going to be coming up. And I bet you that the vast majority of analyst questions are going to be on around the loan platform business because, like I said, it's the most exciting part of their growth story in 2025. So even if you just do the super simplified way of taking $11.8 billion worth of originations over that period, and you just multiply it by 4%, it comes out to around 470 million. And you have to keep in mind that these deals are over multiple years. So you can't expect SoFi to make 470 million this year alone because for Fortress, for example, it's over 2 years and they have a 2-year extension. So is that 4 years or is that two swim lanes of 2 years each that stack on each other? I don't know. But basically, 470 million is around the range of what you can expect in revenue, assuming that 4% take rate. Now, the other thing to keep in mind is that that's just revenue. There's also servicing fees and other fees involved before that trickles down to the bottom line. So even if you extrapolate this out and you divide 470 by 4 quarters, which realistically we know it's about 8 quarters or more, but even if you say 4 quarters because they're going to do more deals, their deals are going to stack on top of each other, that's around like 90 to 120 million per quarter after all the servicing fees. Again, I'm using super rough numbers here. I'm just doing back of the napkin math around what we've seen in previous deals with Blue Owl Capital and others. But that's still incredibly bullish, right? Because that's $100 million per quarter that you didn't have before. And that's $100 million per quarter that's going to be the foundation of future growth. Because next year, they're not going to do just this volume of deals. They're probably going to do more deals and they're going to do more origination volume and they're going to do more growth through the loan platform business, right? Because that's the most exciting part here is the volume of growth in the short duration of time, which is going to massively increase as this continues to scale for reasons that I mentioned previously in this video, right? It's going to make other people turn their eyes and say, hey, what's going on over there? Like, why are they doing so much money with SoFi? There has to be something there. And so I can imagine a world in 2027 where SoFi is doing 200 million a quarter in loan platform business deals. Like, I can totally imagine a world like that. The limiting factor is going to be how many loans can they actually originate? How much demand is there going to be, not from the third parties, but actually from the end consumers who are going into SoFi's website asking for a personal loan? Like, just how deep is that pool that they can chunk out and package and give to the third parties? So that's my biggest concern right now. And it kind of makes sense because management has said we're going back into growth mode. And what does that mean? It means that they're reinvesting back to the business. They're reinvesting into the growth. We're seeing commercials on the play-in tournament. We're seeing website traffic be at all-time highs. It makes sense for SoFi to be throwing all of this money to get more people asking for personal loans because clearly on the other side of the equation, from a third-party perspective, the demand is clearly there. And so that's something that you also have to keep in mind, right? That as more quarters pass, you're going to see more and more of this loan platform business revenue, but you're also going to see more and more expenses on sales and marketing because SoFi needs to basically have consumers at the end of the equation on the other side to meet the demand that these third parties have for packaging new deals. And when you put it all together, where they focus on is basically where they think they can have more money that falls to the bottom line. The loan platform business is the right thing to focus on. And these press releases validate that point that Anthony Noto has been saying. Because while we on the retail side give him a lot of flack for options level one or brokerage side, competition with Robinhood, all of this stuff, they're actively choosing not to focus on that because they know that there's not going to be enough money there. In a recent interview, even this week, Anthony Noto hinted at that fact, saying they're going to be in a winner take most type of market. And on the brokerage side of the business, the winner is probably going to be Robinhood. He literally said Robinhood in that interview as the winner take most in the brokerage side. He also mentioned the firm in the buy now, pay later space. But instead, SoFi is focused on the competitive advantage they have in the loan platform business because this is something that the bank charter allows them to do. And it's a very favorable risk to reward profile for their brand, their vertical integration, and also the benefits that the bank charter allows them. And it reminds me of that Peter Thiel quote around creating monopolies, saying that if you have to compete in a space, you don't really have an advantage there. So focus in areas where you do have little to no competition, where you have a competitive advantage. And the fact of the matter is, in the loan platform business, they have way more of a competitive advantage relative to their peers. So what's next? I think the macro is very uncertain right now. How long are tariffs going to last? How impactful are they going to be to the actual end consumer? Are we going to see higher unemployment as a result of the macro? Higher defaults as a result of the high unemployment? All of these things are driving the market down in the short term. But there's a few things that we know for sure. Number one is that the volume of loan demand is very strong. And we're seeing that through the frequency of these deals. Number two is that SoFi takes on much, much, much less risk because this is all fee-based revenue. So if the economy were to go down, if tariffs are prolonged, if unemployment goes up, if defaults go up, SoFi is insulated in that because they still collect their fee from their originations and the risk is taken on by that third party. And the third part is that this company is still executing regardless of the macro conditions. So there is arbitrage to be found there, in my opinion. Of course, do your own financial advice. This is not financial advice, but I am looking at it through what is the company doing from an underlying execution perspective? Are they growing at a fast pace? And the answer is yes. And what is the stock price reacting to? And in this case, the stock price over the course of 2025, down 22%, has reacted to macro uncertainty, macro fear around tariffs, which do not affect SoFi directly. I've mentioned this in previous videos. And these pieces of news, like the one that just came out yesterday, is excellent validation of the effectiveness of the underlying business continuing to execute time and again and actually accelerating in their execution. And so that's why at the beginning of this video, I said this is the most bullish news for SoFi I've seen in 2025, because this is one of the biggest, if not the absolute biggest, loan platform business to date. We're going to be talking about this tonight on our podcast, which we still haven't had a name for. So please join us there, 10 p.m. Eastern later tonight. Thank you so much for watching, and let me know your thoughts in the comments below. I'll see you in the next one.